Well, good evening, everyone. If you're just getting on, appreciate you joining us tonight. I'm really looking forward to the conversation. We're just hitting the top of the hour now, and I always like to give 2 to 3 minutes, to let everyone finish dinner, finish work if they're some of our community on the West Coast, and then get into the conversation. So just hang tight, for another minute or two, and we'll get started. We are going to be taking questions tonight at the end. But if you got questions along the way too, go ahead and write them in the chat box. If you want to tell us where you're visiting from, we always like to hear that in the chat box too. We get an array. Last time we had Australia, California, Canada. I think there was one from South America, and then all over the US. Yeah, please let us know. So Jaden, my right hand that helps me stay organized, and the slides would not look half as pretty without, or a lot of the people have gotten books. Obviously, she helps keep a lot of our education going, is on tonight. And so is Allison. Now, a lot of you guys know Allison Thomas. If you're already existing clients, Allison has been with us for a decade. She was in wealth management, left Wall Street, went into real estate investing with us, and has worked with dozens and dozens and dozens of clients now over the years to build successful portfolios, invest herself, and she's going to be helping me moderate tonight. So it's good to have our team here, and we'll get, any questions. She's going to be helping me monitor the chat box, and we'll have a great time tonight. So again, it's a great conversation. We're just going to two principles that really do affect whether a deal works or not. And that we've really tried to work hard to get better results with our overall build to rent program, our turnkey rental program. And we'll go over exactly how and go into some comparisons. But I want to understand how we do it and how it works, because insurance and interest rates on mortgages seem like a simple concept, but there are some important facts to know in order to steer yourself with the best examples. And whether you work with us or not, obviously we want you to, you can take this information anywhere and know exactly what to look for. So let's wait another minute, guys, and then we'll get started. All right. Yeah, and if you guys are just joining us, I like to wait till about 3 after the hour, let people finish dinner, finish work if they're out on the West Coast or somewhere else earlier, and then we'll get started. So again, no bad questions. Put them in the chat box. Allison is there to monitor. She is a wealth of knowledge, and I'll be happy to answer them as we go through or at the end. So we'll go from there. Again, remember, there are no bad questions. So ask away. That's what we're here for. I always like doing these live. I think you guys seen, we don't really send out, I mean, if we've done it, we'll send out the recording by request, but we love to do live webinars because I think they're the most genuine, and also you can be in real time to answer questions. Last one that we did with Allison, I think we had it was like 23 questions at the end. So we went a little over. I think we'll go about a half hour and be done by 40 after the hour tonight, just so you guys know. I know you want to get with family. So, well, hey, it is 3 after, so we gave people a couple extra minutes to join. Thank you for being here tonight. My name is Jim Sheils. I'm partner of Southern Impression Homes. And I'm going to talk a little bit about our business, who we are, what we do. But the main subject tonight is insurance and interest rates. And these can be the secret to real estate success, getting your investments off on the right foot, right cash flow, long-term growth. And it's something that people overlook and say, well, insurance is what it is, or interest rates on a mortgage are what they are. That's not true. And we're going to break that down. It's been one of the ways we've been able to succeed in the system that we've built is in these two things alone. So sweet spot for us, as a lot of you guys know, we only do new construction, residential real estate only, single family homes, duplexes, and quads. This is where we found the sweet spot to build wealth for ourselves and our clients. And that's all we do. We are very heavily in Florida. And as you see, I always say this, you notice we're not in Orlando, we're not in Miami, we're not in Tampa. You hear a lot of stuff in the news. Oh, we've heard real estate soft in certain markets, and the markets that are soft right now are the ones that have been the most attentive and gotten the most, attention through the pandemic, and were too expensive. I like Orlando. I like Tampa. I like Miami. I have family and friends there. I don't invest there because the building numbers didn't make sense, and neither did the cash flow. We like to go to more of a second tier market where they're experiencing the growth factors we look for. And these are the markets that we focus on. Now, I was taught this over 20 years ago by a real estate mentor of mine that don't depend on appreciation, but do your best to get in its way. And there are 5 factors that determine if a real estate market is poised for growth. And it's these 5 factors. We will not build in a market unless we have these. First thing is economic growth. How are the jobs doing? Second thing, population growth. We want to make sure that's going up. That's why we don't go to the Midwest and areas where it's depleting. We like these markets in Florida where it's going up. Affordability. I'm sure some of you were on my kind of State of the Union last month of dissecting my favorite market in Central Florida for this year. And the reason why is affordability. This is the key word, the key factor. When economic conditions are unknown, we look extra strong at affordability. So we will only build affordable housing that's based right around the median. And we want a good affordability. The affordability in Ocala, Florida is much, much different than Miami, Florida. And that's why we're in that market. And along with affordability, we want desirability. You know, can I walk down the street at 9 o'clock on a Friday night, not have a problem? Are there people drawn to want to live there? From a landlord perspective, is that state or county landlord friendly? This is what we consider desirability. And obviously, as a builder, healthy supply and demand. We want to go where the counties and municipalities are saying, hey, we don't have enough rental inventory. Could someone please build more? And so that's where we go for healthy supply and demand. These 5 factors, this is what helps you poise for growth and the best success. If anyone wants a copy of the book and you haven't gotten a copy, we put a lot into this. My wife and I, my partner, our property counselors, our clients, lots of case studies in this. And it talks about our journey going from old fixer-upper houses to the new construction model about 10 years ago. And it was doing that really got me to buy back my time, created a lot of wealth for myself and for our investors. And it gave me a legendary family life. And all that means to me, guys, is I'm able to do the things I want to do with the people I love, and I have the financing to do it. I couldn't do that as a kid. So a great book. Of course, that's coming from me, but it did a USA Today bestseller, and we'd love to give you a free copy. Just put it in the notes to Jaden. She'll get you out a free copy. Oh, excuse me. What we do, excuse me, we build right, finance right, and manage right. That is key. And if we can do these 3 things for you, we take a lot of risk out of the equation and up your odds for success for a long-term buy and hold portfolio. Tonight, we're really going to focus on finance right, because mortgages are an absolutely crucial thing to get right in order to get your real estate investment off on the right foot, but also insurance. And a lot of people don't look at insurance. They think it is what it is, but there are ways to get better insurance. And I'm going to talk about that tonight. Now, a lot of you know we have nearly $1 billion under asset management, creating $56 million in annual recurring revenue for our clients. We've created over almost $200 million in equity for our investors just in the last few years. We have over 1,000 active investors right now and growing. We've developed over 9,000 units, housed over 10,000 people. Our team is 120 plus and growing by the week. A minimum investment. In order to work with us, guys, you're going to need about $80,000 to get started. That's going to get you your down payment, your closing costs, some reserves. And we know if we can get that going, then we can build you a successful portfolio. Someone like Allison, I know right before this call, she was talking with someone she's worked with for 7 years, and they're incrementally buying property with us. And so you might not be able to do it all at once, but $80,000 will get you the right start. So we also have 5,000 lots in Florida that we're wanting to build out in the exact areas that I was talking about in those 5 factors, and we plan to build those out over the next 4 to 5 years. We're very excited about that. Now, I want to talk to you guys today about I heard investing, and this is kind of funny. It's the hearsay. It's the rumors. It's the undocumented, untrue facts, if you will. When you say I heard you can't get insurance in Florida anymore. I heard that mortgage rates are impossible now, and you're going to have to lock in at a high rate. On the surface, that might seem true, but for people that really focus on best results like we do with our system, this is just absolutely a rumor and not true. And we talk about that in our system. I'm going to go over a few things tonight. Now, let's talk about hurricanes. Right here, we are looking at Punta Gorda, Florida, the day after Hurricane Ian came through. Large hurricane, the eye of the storm, that means the most powerful part went right over this area. If you saw in the beginning of this video, there was one roof that had a partial roof removal. But if you look through, all the houses here look pretty darn good. There's some water, there's some fence pieces down, some palm fronds, but everything's intact. Why? Well, Punta Gorda, Florida was destroyed in 2004. I had an uncle living there. Very, very sad situation. The area was destroyed, and that was 2004. And at that time, the government stepped in. It was Hurricane Charlie, and they said, forget it. We're done with this. new rules. If you're going to build again, you got to build up to a certain ground level, and you got to use stronger structural design and stronger fasteners. And as you can see with this big hurricane, Hurricane Ian, going through a few years ago, this looks pretty darn good. So it is showing that this higher ground and the stronger structural fasteners make a difference. So if you're building on stronger ground, building with stronger structural designs and materials, and we build, even though we're in a lot of coastal areas, most of our properties are a few miles inland. And once you go a few miles inland, a lot of that risk goes down. Now, insurance companies, guys, are all about risk assessment. They're always assessing, how does something perform through something? How is it made? And so when they look at one of our properties, for example, that today has to be built at 13 or 14 feet above sea level, opposed to one built in 1952 at 2 feet above sea level, and it was built to a weaker structural design compared to our new construction, they know that house is a lot bigger risk, because through those hurricanes where you just saw those houses were fine, there were a lot that had a lot of problems. And again, they were on lower lying ground, and they had an older structural design that just didn't hold well in hurricanes. In fact, in that large hurricane, Hurricane Ian, we had 278 projects, and only 4 needed insurance claims after that. And let me tell you, the 4 that needed insurance claims, we didn't have any flooding. All it was we were in the beginning building stage, and so we had put up the block walls, but no roof. And so the wind was able to catch it and knock it over. Once you tie the roof on, that gives it real strength and integrity. But the walls just fell over, so it's a little over 5,000 in damage. We had to file for those, but we had no flooding. And believe me, when we perform like this all over the state, it's usually Southwest Florida, which has our biggest hurricane risk of any other places, but we've performed so well for the insurance companies and our clients. The insurance companies obviously want to keep insuring us. So they'll look at our properties very differently than other properties. You know, a lot of the times, and I've talked about this before, my personal property, I live about 75 feet off the beach. It's only 10 houses wide on a barrier island. We love living here, but there's a risk. But my house was built in 2004. You go a little bit down the road, there's little beach bungalows built in the 1950s, cute little houses, but they're built at 2 feet. And they've had flooding in the last 10 years when there's been some storm surge that's gone through. I've had nothing. Even though their house is maybe a quarter the size of mine, their insurance is 5 times the amount. 5 times the amount. Now, that's a little extreme. We normally see older houses similar to our new construction model that are about 2.5 times. But still, that's a big difference. And when you have higher insurance like that, that eats away from your rental income and right away from your cash flow. That's why we only do new construction now, guys. And look at these prices on new construction. A lot of people, when they're thinking, gosh, insurance, it's going to be so expensive in Florida. I heard it on the news. I heard it from my brother's uncle. Whatever it is. Let me give you some real pricing. So Southwest Florida, like I said, one of our more high risk hurricane risk zones, $116 a month for this single family home, full coverage. This is just this month from our insurance carrier. Jacksonville, lower hurricane risk zone, where we really started, but this is a duplex. Insurance for 2 units now, $103. So just about $50 a month to insure a new construction property, full coverage. Palm Coast, beautiful area. Love this. Closest to my personal home. I go down there a lot. My wife and I got engaged there. It's a beautiful market, and a little bit more higher end lifestyle wise. But you can look, this is a coastal community, only a few miles inland. This single family home, $78 a month. Here's another one, $112 a month. And then let's look at Ocala. Ocala, now this is a single family. This is a duplex right here. This is a duplex, 2375 Northeast 10th Street. The insurance is $92 a month. So less than $50 a month per unit for full insurance coverage. Here's another duplex, $96 a month, full coverage. Again, a lot of people are going, holy cow, I thought there was, from the rumors I heard, it was $96 a month. It was $960 a month, which honestly, you could get charged in some very close to the coast, lower lying older properties. That's just not where we focus. That's why we love our new construction model. And look at this one, Inverness, single family home. Full coverage, $61 a month. These are new insurance quotes. And remember, our insurance carrier, they've insured hundreds of properties just like this in the area. So these aren't maybe, these are very clear quotes. Now, That's insurance. We're going to get back to that in a minute. I want to talk to you guys about interest rates, mortgage rates, right? Man, June of 2022, we saw the hockey stick approach. It's just, it's unbelievable. The hockey stick just whoop, they went up for 2 years. And the last 2 years have been brutal. And when I say the 2-year high, it's gone up really high for the last 2 years, but we're at a 26-year high for mortgage rates. So I went in, I built my first investment property 25 years ago. So this is new for me. This is even higher than I was. And I remember with good credit, my first triplex I bought, first property ever, was an interest rate of 9.125. So I'm a little jaded. I went in at a weird time, but even then that was a different time. And the rates now at a 26-year high are starting to affect the numbers. Still better than what I was seeing banks doing. You know, a lot of this we can't get in tonight has to do with the 10-year treasury. But, you know, can you still find cheap money? I couldn't find cheap money 20 years ago, 25 years ago when I bought that first property because I was a new investor. I was putting less down. There were different loan programs and they upped my rate. We try to go the opposite way for our clients now to get the best rates to give instant cash flow. And a lot of people told us it is impossible to build properties in good areas, new construction, and get them to cash flow right off the bat. We didn't agree with that. And we found through helping with better insurance, doing new construction, and doing our own in-house financing, it made a huge difference. So introducing, guys, the builder forward commitment. Now, I didn't even know what this was a few years ago. You got to remember, I wore the rehab badge of honor on my shoulder for years. You know, I did hundreds of rehabs and I was, you know, proud of them. That's what I did. But once I started the new construction, I put those rehab shoes away. But that's what I first started in. So I wasn't in new construction. So the builder forward commitment was a newer idea that my building partner, that Chris, brought to me. And what it is if you're a builder and you have a healthy balance sheet, but luckily we do, as most of you know, we're partially owned now by Sumitomo Forestry, a 300-plus-year-old company with a huge balance sheet. Warren Buffett is heavily invested in one of their other conglomerates. We have no bank debt and a great balance sheet. That gives us the power to be able to apply for builder forward commitments. And what builder forward commitments are is we're not only in the house building business now or the property management business, we're in the money buying business. Builder forward commitments allow us to reserve and commit to large tranches of mortgage money, and buying this large money upfront from these banks, and we work with 2 different banks, we're able to prepay to buy down your rates. And that is something that I wish I had known about 15 years ago. It's just, I didn't understand it, I didn't know it, and probably wouldn't have qualified for the builder forward commitment anyway. But these have been absolutely pinnacle to the success of our new construction turnkey program, because a lot of mortgages you guys call, you know, Wells Fargo, Bank of America, any big group that you want to name for, let's say, one of our duplexes, like I showed, they're probably going to start your rates at about 7.25%. That's pretty average right now. Right now with us, through our builder forward commitment program, we're buying these large tranches of money. We're passing the savings on to you. And you can lock in anywhere from 3.75, which is a 10-6 ARM. That means it's a 30-year amortization, 10-year fixed. Or if you say, no, I don't want to do 10-year fixed, I want to do 30-year fixed, 30-year AM, that's fine. You can go 4.25. This gets you, as you can see, 3.5 points below what other mortgage companies are offering. And when you start to do your numbers, if you're you know, an old pro and you're on this, you know right away what that does to a few $100,000 mortgage. You know, locking in 3.5% lower. I mean, that goes right to your cash flow. It makes the difference of a deal working or not working. And this is something we worked really hard on, and it's something we've gone full force into. I mean, the amount of money we're reserving and working with the banks, we want to be able to offer this as long as possible, because our goal is to buy in the right areas, build it the right way, and get you cash flowing right off the bat. You know, at 7.25, it'd be really hard to do. I'm going to show you that right now. And also, if you look with this, our program includes not only the lower mortgages, but for all of our new construction properties, we offer the first year, two years of free property management. Now, this makes a huge difference as well. That normal 8% that we would charge goes right to your cash flow. So think about it this way. We're going to look at some numbers, but think about it this way. First thing with the insurance, we're going new construction. Right away, they like us for that, and they give us respect by offering us lower rates. There might be a house the same price, but if it's 25 years old and built to a different structural design on lower lying land, that insurance can be 2.5 to 5x what our insurance is. Because again, insurance companies are all about risk. And those properties are the one that suffered damages in storms, opposed to ours that did really well. So that's the first thing. So you get lower insurance, sometimes, a 2.5 to 5 times more if you bought old compared to what we're getting. You saw some of those prices. Now, the second thing would be the financing. This is a big piece. You're locking in, let's say 3%, 4%, I'm sorry, 3 to 3.5% below what the other banks are offering. That's huge. And now you're also not paying that 8% management fee. All three of these guys go to your bottom line. They go to your cash flow. They get you off on the right foot. They get the wind at your back. And that's what we want to do. Remember, we work with over 1,000 investors. Now, our most successful core group of investors normally buys about 3 to 8 properties, right? We have people that have bought 15, 20, 28 properties as individuals, and we work with some of the big guys. But our individual investors, the sweet spot is usually about 3 to 8 properties. Because that becomes a solid little residual side business that doesn't cost them a lot of time. Again, our goal is 1 to 2 hours a month. And that's just kind of where people, get into a sweet spot with us. We got to get you off on the right foot for the first 1 or 2 in order to get you into that sweet spot. Because if we don't do the first 1 or 2 right for you, you're not going to keep going. That's very obvious. So we work really hard on that. And we knew we got to get insurance better. We got to get the best financing possible, build a forward commitment. And yep, we're going to make it into the numbers. So management fees don't kick in until year 3. And I'm proud to say 95% of people stay after these 2 years with us. But let's look at some of the numbers. I always say, show me the numbers, right, guys? Let's look at that. So, because the strategy that we're trying to put together is cash flow and long-term wealth. We get the wind at your back now before we wait for everyone to say, let's wait for interest rates to drop. Let's see what's happening. If we can get you in now and you don't have to worry about that, we know we're getting you an advantage. So let's look at this. So this is one of our Inverness duplexes. I know Allison just sold one of these today. 3.75% interest rates, 419.9. So you're getting in just a little over 200,000 per unit in a great area of Inverness. If you guys want to learn more about that, just drop in some notes. We can get you the market report. I just talked about Inverness 2 weeks ago in my webinar. With the 3.75 on the duplex, you're looking at a mortgage of $1,458, taxes of $525, insurance, like we looked at before, $96. We do lawn care and maintenance of $187 a month, and that's on new construction. I'm not going to get into the 2-10 warranty tonight, guys, but just know that's an extra layer of protection for you. And no zero for the first 2 years in property management. We waive that 8% fee. So put all those total monthly expenses in. You're at $2,151. The income coming off from both sides rented, $2,830. That's a starting cash flow of $679. Now let's get back to that I heard investing. I know a lot of you have said, I heard you can't cash flow properties. They're ridiculously priced. Inverness is one of the best markets showing that is absolutely a rumor. And look where you're starting off. Brand new construction, 210 warranty, great area, and $679 cash flow. But you're saying, couldn't I just do this on my own? Well, let's look at this same duplex. Let's say it's a duplex but it's 20 years old. They're asking the same price. Let's say it's in a little better area, but they're not going to get our mortgage rates. They're not going to get our insurance, and you're going to get charged PM with someone else, property management. So when you look at that, $419.9 price, mortgage of $2,148, taxes same that it would be. Insurance though, insurance is going to be about 2.5 times. That's again on an older property that's been built to different structural design. You're normally going to pay. And this is an estimate, but that's something we got from our insurance guys' estimate, old versus new. Same lawn care and maintenance, but hey, property management, you're not getting that free those first 2 years. You're at $226 a month, collecting at 8%. Now your total monthly expenses, guys, are $3,261, an income of $2,830. So now you're at negative $430 a month. I want to go back to that. Let's look at that. With our program, the insurance, the mortgage and no property management for first 2 years, you're starting at 679 compared to negative 431. We're talking $1,000 swing. This is why we put this program together. I mean, we've worked so hard to put these pieces together, and I could never have imagined 15 years ago, 20 years ago, when I was doing, bulk rehabs, that anything like this could happen. And another thing that this can't show is when I did old properties, guys, my average tenant would stay 13 months, which isn't bad. But now with new construction, we're getting an average of 3 years. Huge, huge difference. So again, going from 679 to negative 431 on a duplex. Let's look at a single family. So this is Ocala, right near Allison lives out in Ocala. So great starter home, 3-bedroom, 2-bath, just over 1,400 square feet. These are in such high demand, this workforce housing. A lot of the builders don't want to build them. Again, a lot of we're a low margin builder. Our whole model is we will make less off of each property working with you, but we'll do volume. And a lot of builders don't want to build these, but these are in very high demand right now. And look at this. This is why. I mean, when you're talking about that key word, affordability, brand new construction still, under 280,000. And the area for Ocala, I didn't have this on here. The average family income is 72,000. That is a very healthy number. It's called an affordability index, guys. I always encourage you to look for that. What's the average purchase price? And this is right around it. I think the median price in Ocala right now is like 282. And so we're just about at that. And the average person makes 72,000. That's the average family income. That's really, really healthy and something you always want to look for. But let's look at this. With our program, you're getting that 3.75 rate, 965. You got your taxes, the low insurance on the new construction. You're going to have maintenance and others that we estimate for. No property management fees. That 8% is waived for the first 2 years. So we're at that 1338, 1715 coming in. This single family, you're starting at almost $400 a month cash flow. I feel really good about that, especially new construction, and knowing too, the people that get into our single family homes, especially, they like to stay because where else are they going to find a house like this? Because they're just not as available for renters. A lot of these are available only to owner-occupied people. So, renters really appreciate having them. So here we are, guys. Let's look at this number, and now let's click over to, similar house, let's say, but it's an older home. They're asking the same price. You got to go into the mortgage company without our builder forward commitment. The insurance is going to be higher. And let's look, you got property management too. So look at that. The mortgage is higher. Taxes are the same. Insurance is about 2.5 times. Maintenance and other are the same. PM, property management, kicks in at 151 a month. That's going to take you to total expenses a little over almost $2,200. And a monthly income's only coming in of $1,715. So taking all that out, guys, you're at a negative $466 a month. Okay. So 378 to 466. Why can we do this? Why can we make this happen? It's very simple. And that's why I wanted to show you guys new construction gets treated differently by insurance companies and gets cheaper rates. Interest rates matter a lot when you're financing a property. First of all, real estate, the beauty of real estate, Allison used to do the stocks. You buy $100,000 worth of stocks, you usually have to put up $100,000. You buy a $200,000 house, you only have to put up $40,000. That's the leverage. And part of that leverage, whether it's going to work or not, is that interest rate on that long-term mortgage. With us being able to get the better insurance, the builder forward commitment, pass those savings on to you with long-term debt. Again, we're not talking about 18-month adjustables or any of that. I'd tell you, be very careful wherever you go. If someone's offering you a deal and it adjusts in a year or 2, even 3, man, that can come really quick. You're putting yourself in danger of jumping to a rate and getting yourself in trouble. Look long-term for this cheap debt, which we get for you. And also the PM, having no PM, that 8% goes right to your bottom line. This is what makes the difference, guys. That's why we stopped doing old rehabs. That's why we went only to new construction. And these are the houses we focus on. So any questions? We're getting done right at the half hour, which I feel good about. Does anyone have any questions? And Allison, I'll let you kind of chime in if you could, young lady.
Absolutely. I loved what you did, Jim, with the comparisons. That is so visual and really great to be able to see. So thanks for doing that. That I really Really like that. So who's got questions for us tonight? We've had a few over here in the chat box, but what else have we got, folks?
And I had one come in, Allison,
Mm-hmm.
of saying, it's basically a person talking about they're from California, they're coming over, which I understand because I invested in California for years. I'm worried about hurricanes. What would you suggest I do? Okay. First of all, what I would suggest you do is if you are coming to Florida, of course, I'm going to say, I hope you buy with us. Let's say you don't, you go to some other market. I would get your insurance quote first before you ever agree to buy something. And I would also remember 2004 or newer. There was just a change in requirements. And a lot of the times a home built 2004 or newer is going to have a better rate. Also, you can be in a coastal area, but if you're a few miles inland, know that your insurance is going to save. With area, look, the highest hurricane risk zone is still that bottom southeast area. We don't build there. It's beautiful. I like it. I love the Florida Keys. That's your highest risk zone, though. And then our highest risk zone that we buy in would be Southwest Florida. Again, with your property counselor, you can go over our performances, where we build, how we build there. But if you're just completely terrified of hurricanes, guys, I always say, just go to Jacksonville or Ocala or Inverness. These are the lowest hurricane risk zones in the state. Nothing is impossible, but the chances are extremely remote of an issue there. And the insurance premiums show that. Again, the risk analysis for big insurance companies show that. So if you're really afraid of them, again, look into, before you buy anything, what the quote might be. And if you're just not comfortable and you're going to work with us, I say, just go to Central Florida or Jacksonville. That have the lowest hurricane risk zone.
Awesome.
Great.
Yeah, Jim, we had another question. Will DeSantis eliminate property taxes?
And I hear, right? I hear investing.
Right,
So
right.
I heard this, and truth be told, I got a little excited because I thought I never heard of that. What the heck's going to happen? And I was kind of skeptical. However, I have been reading more about this, especially over the last week, and making some phone calls of, is this for real or not? Now, I don't know everybody, but I know a few people that are kind of close to the source. And there is some seriousness to this. And their thought process is, when they say remove property taxes, that's not for larger corporate buildings or commercial, but residential, they're looking at that. And they believe there's other ways they can make up the estimated 40 billion collected a year through sales tax and other things. So it is possible. It is possible. Let me show you something. I just want to go back. Okay. Look at this. Taxes right there. Imagine this happened on the single family if they did eliminate taxes. And for our out of area investors, if they put it on our sales tax, well, you're kind of like, well, I don't really care. I'm not shopping there very much. That's going to be more on me and Allison and Jaden. I can deal with that for this type of property tax. But let's say if they eliminated taxes, well, that 347 in taxes goes right to your cash flow. Or let's say they got rid of half of it. So it's just going to add $170 to your cash flow, and look at on the duplex. Holy cow. I mean, you're talking adding over $500 a month to it. Or if they just cut it in half, you're adding $260 a month to your cash flow. So it's a very exciting idea. It actually makes sense of how we could do it. I've never heard of this. Remember, I came from California years ago where no one talked about eliminating. They just talked about adding taxes from what I could see. And so I never thought of this, but it does seem like it has some viability. I think it could take some time, but I do know it's going to draw attention because let's say that this takes 18 months. What do you think would happen to investment dollars? Do you think they would run away from the state or would they run to it? I think they'll run to it. So it could do some very interesting things, but it is on the table. They are serious about it, and it'll be very interesting to see developments over the next 6 months.
Jim, here's a great question from Karen. She says here, I see frequently due to various reasons, the property values of Floridian homes are at risk for notable decrease in the next couple of years. What are your thoughts on this? Any thoughts?
Yeah, it's a great question, Karen. I tried to go through that before. Florida has 29 million people, 29 million people. So we just did a webinar with our Canadian network yesterday, good friends of mine, and they're like, holy cow, we have 30 million in all of Canada, you have 29 in Florida, which means there's a lot of different real estate markets in Florida. And if you remember that map that I showed you, we're investing in second tier areas that are experiencing growth, but I wouldn't call them really the fancy areas. Remember, my main word of the year is affordability. So we're going to affordable markets. That means markets with a very affordable median income and median house price. So like we were showing Ocala, like I said, it's still under 300,000. You go to an area like Miami, it's more than 2 times that. You go to coastal areas where the insurance has gone up and they're very nice luxury homes, but those really shot up in the pandemic because people liked Florida. They were coming here. But again, those are emotional markets without cash flow. So those are the areas that suffer. So when they do an average of Florida and they say Florida real estate pricing is dropping, they're bringing in all of those areas and then combining them. And so I always say it's very important to segment out, like, again, since we use examples from Ocala right now, properties are selling an average of 62 days on the market. There's a 5-month supply of inventory. That's very normal. In the pandemic, it went down to about 3 weeks. But comparatively to 5 months back in 2008, when the market crashed, there was 17 months of inventory. So we're at a very normal market. And it's hard to fall off the floor when you're getting new construction properties in areas with jobs and demand. They're still wanted. They're still affordable for people to buy, and they're still affordable in the rent wise. You go to the higher end, that's where we're seeing problems and we've seen drops. Like, I'm really glad, as tempting as it was, we didn't buy a lot of land in Orlando, Miami, Tampa. Those are beautiful areas, but it was too expensive. The numbers didn't make sense. And now those are emotional markets, because what I found is a house is worth what it can rent for. I think Warren Buffett said that it's worth what it can rent for. When it all comes down to it, that's why we go to the type of houses we do. So just, again, when you're hearing these things about Florida dropping in value, dissect a little and say which areas. And I think if you do your own research, you'll start to see, yeah, there's some areas that have come down. I mean, they went up unbelievably in the pandemic times, and they've come down some. I mean, they're still way above where they were in 2018, 2019. But I'd look at these areas because other areas that we work in, that we focus in, that has not been felt because they've gone up, but they're still at a much more affordable level. Hopefully that helps.
That's awesome, Jim. And Richard asks if we have any plans to expand to other states.
So we are, and I've talked about this, we are actually actively building now in Texas. We're building in North Carolina. We're doing some things in Georgia, not Atlanta. We will not build in Atlanta anymore. Full disclosure, the landlord laws got so terrible, we refuse to build there anymore. But other areas of Georgia and then Tennessee. We're working, so you guys know, we get hired by some of the bigger hedge funds and institutions to build their projects. So with these newer markets, we always like to build and test with them and see how it does before we bring our individual investors into a market. So our main focus is still Florida. We're dialed in here. We know what's going on. We know the comps of real values of rentals, have the management set up. We will be going into other states. It's probably going to be 2+ years because we want to test with these other people. But those states that I just named, we're active in already, and we will probably be doing some offerings in those areas.
Great. Thanks, Jim. Pauline is asking if we have an insurance company that we recommend or work with.
Yep. So when we first started this, and again, so there might even be some people on here, old fixer-uppers to the new construction. But when we first started this turnkey real estate model, it was always, well, Jim, who do you use? Or Chris, who do you use? And so it kind of started very organically who we use. Now, the majority of my properties are insured by Leland Insurance. And so we have no financial affiliation with them, but we know we get it done, and we know they love our new construction as well. So Leland Insurance, Chris Salame there, he's our favorite. And he loves our houses because our proof of concept has been proved. They've done thousands of them. We've survived, hurricanes in Southwest Florida without issue. And we love him because his rates are great. And we found if there has been need for an insurance claim, he's there to pay. So that's who we use.
Awesome. Jim, do we have time for one more question?
Yeah, let's do one more.
Okay, this is from Oleg, and he's asking, how is the Jacksonville market? Is it one of the markets undergoing softness / correction?
The only area, remember, Jacksonville is the largest square mileage city in the nation. And in Jacksonville, you have Doctors Lake, that's out to the west, but then you have Ferrandina Beach, Amelia Island, Atlantic Beach, Jacksonville Beach, Ponte Vedra Beach, which is a very ritzy area, South Ponte Vedra, Volano Beach, St. Augustine, where I am. These are all considered greater Jacksonville. These areas, again, are more emotional markets. So there was some softening there, but in the affordable homes that we focus to, they're still in high demand and they're still undersupplied in them. So I like Jacksonville. The areas that we invest in are holding strong.
Awesome. Thanks, Jim.
You're
I
welcome.
think we got most every question so far. I hope we didn't miss anybody, but we tried to get them all.
Yeah. So, well, let's do this, guys. If most of you are already working with us or talking to someone, request a call with the property counselor. If you haven't done this already, I wish I had a property counselor in my life 25 years ago. They've done this a lot for other people, for themselves. They can really give you a skinny on the markets, more of our fundamentals, and there's no obligation. Plus, they can get you a free financial analysis from our in-house lender. It's great to know what you can actually do. A lot of people are like, man, I had no idea that kind of lending power to myself. And it's a good feeling. So I would do a one-on-one call with the property counselor. If you haven't, start to work backwards, reverse engineer where you want to be. The future step for us is passive income, active freedom. That's why I went into real estate. I wanted to get real estate in place to get to the good stuff, things I couldn't do as a kid with my own, my family growing up, that I'd be able to do with my kids and wife now. Make that happen if you haven't done that. There's no obligation. We might not be a fit for you, but you're going to learn something and hopefully help you on your journey wherever you go. Also, if we love visitors, don't be afraid to come into town. Anyone tells you don't visit a market you're investing in, I think that's crazy. Now, some people don't have time, but if you do, come to one of our first Friday tours. Our next one is April 4th. We try to do it the first Friday of every quarter. You get to come down. I'm going to teach an hour master class. We're going to tour you through the office so you can see the operation, get you out to the projects. It's a great way to meet and network. So come to one of our first Friday tours if you can make it. Again, talk to your property counselors on that. We can get you all the info. And again, this is kind of our Rosetta Stone. I put so much into this of not just my journey, but so many others. And I think it can cut your time in more than half of what I had to go to. Own less of better quality, understand certain fundamentals. We went through a few of them tonight and read about some success stories of some people that the real estate has provided some pretty cool things. And it's not just the real estate or cash flow, it's the freedom of time or doing their hobbies or, helping a family member. There's some really good stories in there. So you don't have a copy, get in touch with Jaden. She'll get you a copy. We'll be here to answer any questions that you have. I know we're at a little past 40 after the hour, so I lied, but great questions. Hopefully we can be here for you guys. Don't forget that don't just do the I hear investing, search around, shop around for mortgages, builder forward commitments, new construction insurance versus old properties, and PM deals. Again, that's why we put together our program. I hope you'll choose to work with us or we can help you on your journey. But either way, I hope you have a great night. And, we'll look forward to hopefully talking to you in the future. So thanks, Allison. Thanks, Jaden. Thanks for everyone for being here tonight.
You
Take
too,
care.
Jim. Have a great night, everybody.
Thank you.